Hello everyone, this is Fixed Income Outlook and Review for the month of August 2025. In last month, India's sovereign yield curve shifted upwards with yield of longer maturities going up by 20 to 30 basis points. This was post MPC's hawkish tone and concerns that the proposed GST rationalization could increase the fiscal pressures and result in additional government borrowing. Overall, the yield curve has steepened with long yields rising over the past month. In the first week of September, however, the yields have come down by 10 to 15 basis points across maturities as markets got some clarity around the GST related impact. Now I will cover a few key data points which were released during the month. The first one is of course growth number. India's GDP growth surprised on the upside in quarter 2, coming in at 7.8% year on year. But if you look under the hood, the story is a bit nuanced. A very low deflator is artificially boosting the GDP, while nominal growth, which better reflects the current economic momentum, is slowing. Some of this strength is also due to export front-loading ahead of the steep 50% US tariffs announced, while real impact will likely show up post-September. So while the headline numbers look strong, underlying demand is softer than it appears. That said, GST rate rationalization could prove a bit of cushion, helping offset some of the drag from the weaker external demand. Second key important data was inflation. India's CPI inflation eased sharply in July, dropping to 1.6% year on year, the lowest rate we have seen in the last 8 years, and well below the RBI's comfort zone of 2%. The sharp decline was largely driven by food price deflation, especially vegetables, which have seen a steep correction. Interestingly, core inflation edged a little above 4% after staying below that mark for several months. This was mainly due to spike in gold and silver prices. But beyond that, underlying price pressures remain quite contained. So while the headline number may be overstating the disinflation a bit, the overall inflation backdrop still looks benign and supportive. The third important number to watch out for was rupee depreciation. It depreciated around 1% against dollar over the past month. This was under pressure from US tariff announcements and continued FPI outflows. Development around US-India trade deal will be key to watch out for its impact on markets, sentiment and the rupee. Now on to the rate view. Let's start with the global rates. In US, the August job report was a bit of a reality check. Hiring slowed sharply, unemployment nudged higher. It's clear that the labor market is losing steam. What is interesting is how quickly that has shifted the narrative around the Fed chair's recent comments and that have taken on a more dovish tone, acknowledging risk to the employment. Markets are now leaning heavily towards a rate cut in September policy, and a slight possibility of even a larger move than a 25 bips is expected now. Inflation cooling and growth softening, the Fed looks ready to pivot. In India, government bonds have cheapened quite a bit over the last few weeks, and that is starting to throw up some value in the market, but the sentiments are still soft. There are not many near-term catalysts to lift the mood, especially with fiscal concerns lingering. Investors are watching supply-demand dynamics closely, and until there is more clarity on fiscal path and borrowing numbers, demand is likely to stay cautious despite the attractive valuations which are there right now. For FY26, base case is that borrowing numbers should stay steady. We are not expecting any slippages from the budgeted 4.4% fiscal deficit target. But let's say the government does decide to widen the deficit by 30 to 50,000 crores in an adverse scenario than what we have right now. Even then, we think they have enough flexibility to manage it without increasing the net borrowing line. There is some room to tap into small savings, cash balances, or even tweak T-bill issuances if required. So while the headline deficit may shift slightly or not at all, it is unlikely to translate into higher market borrowing. And that's a key comfort which bond markets are looking for. In India, we are pretty close to the end of the rate cut cycle, but we think there is still room for at least one more rate cut, maybe a 25 bips in one of the next two policies. Inflation is right now below the target. Growth risks are starting to creep in. What's adding to the caution is the global tariff situation that could hit exports and industrial momentum. A forward-looking monetary policy committee might just want to get ahead of those risks before they start showing up more clearly in the data. That's it. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.